Welcome to the next lecture in which we will learn about the gap psychology. A gap is the unfilled space or area on the price chart in which there were no trades. These are the gaps where there is no trades. Normally this occurs between the close of the market on one day and the next day's open. Lots of things can be responsible for this, such as earning reports coming out after the stock market had closed for the day. If the earnings were significantly higher than expected, a lot of buying interest will be generated overnight, resulting in the increased demand from buyers. And when the market opens the next morning, the price of stock opens above the previous day's close. If the trading that day continues to trade above that price, a gap will exist in the price chart. If the opening price of the next day is higher than the previous day's close, then we get a up gap. And if the opening price of the next day's candle is lower than the previous day's candle close, then we get a down gap. Sometimes gaps are filled. It means price has moved back to the original pre-gap level. Once gaps are filled, the gaps tend to reverse direction and continue its way in the direction of gap. Gaps can offer evidence that something important had happened to the fundamentals or the psychology of the crowd. Gaps are of four types: common gaps, runaway or continuation gaps, breakaway gap, and exhaustion gap. We will understand the types of gaps one by one. Common gaps occur in quiet market when market moves sideways. Here supply and demand are in balance, and these gaps are closed rapidly within a few days. You can see here that these are the common gaps because the prices are moving in a sideways range and it is making a symmetrical triangle pattern. We are getting many common gaps in this range. This is a gap down opening and we get a volume slightly higher than the average volume on this day, but the next day the volume is average. And here we are getting a gap up opening. The volumes are higher than the average volume on this day and the next day is also higher, but on the following day the volume is quite normal. Here we are getting a gap up opening, but this gap is also filled in next few days. Here also the gap is filled and here also the gap is filled by this red candle. So these are the common gaps which are very common and they are not very important for trading purposes. Breakaway gap are important one. They occur when price action is breaking out of the congestion area. Volume is usually significantly high on these gaps due to the increased buying interest. The point of breakout usually becomes a support level in an uptrend and a resistance level in a downtrend. A new trend starts from this gap and we should buy if we get a up gap and we should sell if we get a down gap with a breakout. If we get a breakaway gap with any chart pattern, it is better opportunity to trade. For example, in this chart, the prices are making a rectangular pattern and we get a breakout from this pattern. So it is an opportunity to buy here. The prices are taking support on this resistance level for this channel and now a new trend begins from this gap. They are easiest to identify and most profitable to trade. Runaway gap occurs in the middle of the trend and are caused by increased interest in the stock. These gaps usually not filled and occur in the course of rapid straight line advances. They are also known as continuation gap because the trend continues in its direction and in the middle of the trend we get this runaway gap. They are also known as measuring gaps because they give us a target for the end of the move. This is the gap we get in the middle of the trend because the trend starts from here. So we can get a target point for this trend that the trend will end approximately here because it is the middle of the trend. A good uptrend have runaway gaps because caused by significant news events that cause new buying interest in the stock. In downtrend, these gaps occur due to increased liquidation of the stock position by the buyers, therefore the price continues to drop. The volume is significantly high on this gap, usually 2 or 3 times more than the average volume. Exhaustion gap occurs at the end of the move. They are highly significant. Like runaway gap, these gaps also are associated with rapid extensive advances or declines. During uptrend, it is not followed by any new higher high, and in downtrend, it is not followed by new lower lows. Volumes are crucial for recognizing these gaps. Usually volumes are low till the opening of the gap despite of continuous increase in the price. Once the exhaustion gap begins, volume spikes up significantly. Exhaustion gaps are quickly filled and price reverses their trend. During an uptrend, a bullish euphoria overcomes traders. The price gap up with huge volume and a great profit takes place by the buyers. The demand for this stock dries up and price drops suddenly and the reversal takes place with high volumes. Exhaustion gaps are most attractive and profitable to trade if price moves back into the gap area. A gap opposite to the exhaustion gap is known as island reversal gap, leaving an island behind. It is a strong signal that stock is on its way down, and these gaps are the confirmation of the reversal after the exhaustion gap. It is because when the trend reverses after the exhaustion gap, the opposite forces are so strong the price gaps opposite to the trend. In this example, the stock is in downtrend and here the stock is making a pattern that is a rising wedge pattern. In the sideways trend, here we are getting many common gaps you can see. And when we get a breakdown from this pattern, we get a gap down opening and this is the breakaway gap. The volume is usually high at this gap. It is approximately twice the average volume. Now this is the runaway gap. It is in the middle of this trend, giving us a target for the end of the move. Now we are getting an exhaustion gap here. And you can see the prices are getting lower and lower, but the volume is very low during this down move and it is usually less than the average volume. Now after this gap, volume suddenly increases and this is the confirmation of this exhaustion gap and the end of this down move. This was all about the gaps. Thanks for watching the lecture.